What is going on, my friends? Ryan Williams here, back with another one, and in today's video we are going to be discussing three very safe, very reliable dividend stocks that look like they're at a pretty good discount right now. As you guys will find out later in the video, each of the three stocks we're talking about today has at least 40 consecutive years of dividend growth, which is perfect for those of you out there looking for investments that pay steady dividend income that continues to grow as the years go on. Anyway, before we get rocking and rolling, if you guys are stoked to talk about some dividend stocks today, go ahead and give this video a big thumbs up. And if you guys love dividend stocks as much as I do and would be interested in seeing more content from me, I'd ask you to consider subscribing to my channel as well. At this point, I'm putting out 2 videos every single week. I upload every Wednesday and every Sunday, so there's a lot of great dividend stock content guaranteed to be coming your way. Anyway, thank you so much for doing that, and now, without further ado, let's get into it. All right, guys, now before we get into the main topic of today, I want to try something new. So I want to start working in a new segment into each of these Wednesday videos where I share at least one piece of dividend stock news or stuff going on in the stock market, relevant things that we can talk about. And I figure what better way to kick that off than to talk about a stock that has just been teasing me for months now, and that is Microsoft. So I don't know if you guys have heard the news already. I'm sure some of you have, but Microsoft recently announced a $60 share buyback. Now, this article that I found on Seeking Alpha goes into it just a little bit, and I want to run through a few key points that it makes. So first of all, why are they doing this? And this first paragraph here says it pretty well. If we go a little bit halfway down, it starts to say the upsized share buyback program paired with the increase in quarterly dividends is a testament to Microsoft's optimism on even better days ahead. Despite recent volatility in the broader tech market, triggered by investors' concerns on rising interest rates eroding the value of future earnings, Microsoft is still very well positioned for continuous upside realization. And as you guys know, Microsoft has just seemingly done nothing but go up in share price over the last however long now, a long time now, and they attribute a lot of this, at least recently, to what's been going on just in the world the last year and a half or so. And the article continues to say the pandemic has also played a substantial role in accelerating digital adoption over the last 18 months. The ensuing disruptions have structurally transformed the importance of technology in the day-to-day routines, and operations across all sectors, small and medium-sized businesses, are recognizing the importance of having an online presence with the surge in demand for e-commerce. The enterprise sector turns to cloud computing solutions to enable streamlined, scalable, and secure virtual collaboration in an increasingly hybrid work environment, and everyone is turning to Windows PCs to stay connected and productive under agile working and learning conditions. These fundamental changes underscore the importance of digital capability going forward, which bolsters Microsoft's long-term growth prospects ahead. So that's a pretty strong bull case for Microsoft, guys, and for them to announce a $60 billion buyback program right now when their stock share price is nearing all-time highs really speaks to this company's confidence in themselves to continue to perform. But the big question remains, guys, and this is one that we have been trying to unpack, at least in my last couple of videos, my last few videos, is what do we do from here with Microsoft? Should one buy into Microsoft right now, or is it looking too expensive even despite its performance and future projections? And with that said, I'd be curious to hear your guys' thoughts in the comment below. What is your take on this? Is Microsoft a buy right now, especially considering the share buyback news? Or are you holding off? Are you looking for better value? Are you waiting for prices to come down, which it seems like they've been doing a lot of this lately. So really anything can happen. All right, guys, now moving on, let's now get into the main topic of this video, which is 3 super safe dividend stocks that are currently at a discount. The ones we're gonna be talking about today are Kimberly-Clark, ticker symbol KMB, Altria Group, ticker symbol MO, and Clorox, ticker symbol CLX. Now, there are a few characteristics of each of these companies that I think point to their safety, the first of which being the products that they sell. Now, each one of these companies is in the consumer staples sector, which means that each of them is producing products that a lot of us as consumers use pretty heavily in our everyday lives. For example, guys, Kimberly-Clark sells a wide variety of paper and tissue products like toilet paper, paper towels, tampons, and some of their brands include names like Depend, which are actually pretty comfortable, guys, I'm not gonna lie. Okay, Huggies, Pull-Ups, Kleenex, and Scott. So some pretty big brands right there. Now moving on, although not the most popular products, Altria Group sells tobacco products like cigarettes and chewing tobacco, amongst other things. And some of their brands include Marlboro, Virginia Slims, Copenhagen, Skoal, and Black & Mild. And lastly, you guys all know Clorox for the bleach and cleaning products that they produce. But Clorox also owns brands like Pine Sol, Hidden Valley, Burt's Bees, Brita, and Fresh Step cat litter. Each of these three companies is also pretty diverse in the various types of products that they offer, which adds to their safety. And Clorox is probably the best example of this, guys. As we learned a moment ago, they don't just sell bleach and cleaning products. They sell a plethora of other different things like trash bags and cat litter and chapstick and ranch dressing of all things. Now moving on, guys, another characteristic of each of these three companies that we can look at that points to their safety is their dividend stats. Now, Kimberly-Clark, as you guys can see right now, has a forward dividend yield of 3.44%, which is pretty nice. But really the main point with each of these companies is the number of years of dividend growth, which Kimberly-Clark, as you can see, has a dividend growth history of 49 consecutive years. Altria Group, moving on to this next screenshot, has a forward dividend yield of 7.71%, which is really high. And that has a dividend growth history of 52 consecutive years, making Altria Group a dividend king. And last but not least, Clorox has a forward dividend yield of 2.86% and a dividend growth history of 44 consecutive years. So as you can see, each of these companies has been growing their dividends year over year for no less than 4 decades. And you got to think that only a financially sound company has the ability to do that. And as I mentioned earlier, each of these three stocks seems to be at a little bit of a discount right now. So let's take a look at that. As you guys can see on the screen, Kimberly-Clark here, just in the last year, is down 12.67%. So it has come down quite a bit in share price. But with that said, guys, the PE ratio is still a little bit up there, just under 20, 19.88. And if we look a little bit above the PE ratio at that 52-week range, we can see that it is nearing the bottom of its 52-week range. So in the last year, the highest this stock was priced was $154.19, and it's still about $21, $22 away from that. So there is some upside potential to be found here with Kimberly-Clark. And then if we look at its performance more recently in the last month, it's down another 3.5%. So this stock does look like it is on somewhat of a downward trend. So it may be a good time to start buying into this company right now, or even just continuing to watch it to see what happens, because it is on this downward trajectory. So it could continue to go down even lower than where it's at today. And then moving on to the next stock, we have Altria Group, which tells a different story. In the last year, it's up over 23%, which is not too shabby. And then in the last month, it's up another 0.62%. But the PE ratio of Altria Group is still considerably low, not too far from the single-digit range, which points to some affordability with this company. And it is kind of getting closer to the top of its 52-week range. It looks like it still has about, what is that, almost $4 till it reaches the top. And even if you just look at this price chart, guys, in the last month, it looks like at the end of September going into October, Altria Group really took a dip, really took a nosedive. And that was due to some news of them not being able to sell some sort of product here in the United States. That was some pretty big news that came out surrounding Altria Group that really hurt its share price, but it is starting to recover from that. Okay, and if we zoom out a little bit, guys, we can see that Altria Group is kind of taking a beating in the last 5 years. It's down 22.05%. And in that same time frame, it looks like the highest that this stock did reach was $77.28, which was back in June of 2017, so about 4 years and a couple months ago, guys. And you know what? There's no saying what's going to happen with this company. The stock market is so all over the place, but I would buy this Dividend King right now at its current price. I mean, especially considering it's still under $50 per share and you get a 7.5% dividend yield. All right, guys, now moving on to Clorox. In the last year, Clorox is down 25.3%, which is a pretty nice drop. And just in the last 30 days, Clorox is down another 5.05%. So it is really, really coming down, guys. But this one's kind of interesting because as you can see on the right-hand side of this screenshot, the PE ratio is pretty high, just under 30 for the PE ratio, which for dividend stock is looking pretty expensive, guys. But if we take a look at that 52-week range, it is very close to the bottom, almost at a 52-week low, actually, just a few bucks away. So even though its PE ratio is still looking pretty dang high, Clorox is still looking like in a good spot to buy. I mean, like I said, it's close to that 52-week low. And then right now you can get it 25% cheaper than you could this time last year. But anyway, guys, that pretty much wraps it up for today's video. So thank you so much for watching. If you've stuck with me all the way through to the end. And before you click off to the next one, do me a favor, leave me a comment below. Let me know what you guys think about each of the 3 companies we talked about today: Kimberly-Clark, Altria Group, and Clorox. And that's pretty much all I got for you guys. So with that said, I will now get out of your hair. But thank you once again so much for watching. I really appreciate it. Hope you guys have a great day, and I will see you in the next one.